This is Satya Pradyuman of Sirius Research. Our latest quarterly outlook is just out, the Sirius Dispatch. The title is 2023, Focus on Earnings, Not the Fed. And really, if you look back at the last year, we've been caught in so much of a debate about what the Fed's about to do, what the Fed will do, when will they stop, etc. And I do think that we're at an interesting, important point, which is the investment cycle is likely to focus on fundamentals. In short, earnings are going to matter a lot. So we focus on the firms making money. Potentially, we end up with a much better year. Officially, I think we could mark 2022 as a bear market. A few of the key themes that we echo in here, some of this was to play defense, some of it's to play offense. The idea is the liquidity regime, when you look at where the Fed's at, there is still more of a downward pressure on market returns, and we'll walk through that for a bit. Risk capital is still at risk. We've really broken down innovation growth stocks, and at the same time, credit access for innovation firms are basically shut down right now. So this idea of bottom fishing is probably going to be something that you want to wait on. Market valuations are adjusting. It really is, in a phrase, it's 2023 is a market of stocks, not the stock market. So we love to see how some of these adjustments have been made. At the same time, it is not about the market call. The slowing profit cycle, it really heavily emphasizes our quality bias and also playing offense in 23. We focused on a few things. One, really focus on infrastructure capex. And in addition to that, also this idea of using the earnings cycle to play defense and play offense. Couple things. We've used the barbell phrase quite a bit in 2022, and I think it works very well going into 23 as well. Part of it has to do with a slowing, peaking profit cycle. We know that's underway. The idea of earnings visibility is going to matter, so we've got to have quality. At the same time, given the sort of regime change that's underway with energy policies, notably in Europe, we do think this is a world where commodity prices will be higher for longer. So this offset forces us to balance out this idea of a defensive posture with sort of a gritty leadership. Also, bear in mind, one of the reasons for some of the more constructive views on equities is really the hammering that innovation shares have faced in back into 21 and into all of 22. This panel here relates FANG and ARC, the Next Generation Internet Fund, proxies really for what was working throughout the pandemic. Notice how they both rolled over in terms of performance. Importantly, though, the valuation curves for the smaller ARC related investments, those multiples have basically round tripped. And so the idea of, sort of like the innovation risk that's present, we're a lot less concerned about it. I do think this overhang still remains in some of the largest names. Nonetheless, though, if it is a market of stocks, we're in a better place than 22. And then finally, one reality check is about where the liquidity cycle is. Based on our work on the liquidity regimes, this idea is that if you were to track how the Fed has really removed liquidity or thinned out liquidity in the system, based on our estimates, we're somewhere along 3/4 of the way. We're not coming through this as yet. I think we still have a few more quarters where we've got to watch this very closely. It is a dampener on market returns. So the upshot of this is that I think we are in an earnings-driven market. Fundamentals matter, and as a result, active manager results will likely be better in 23, just like 22. Quantitative models are working better because of fundamentals. Short books are working better, just like 22. So these things are probably the silver linings of a very challenging shift from market performance. Take a look. Always happy to take your questions. Thank you.